Hey, good afternoon, everybody. Michael Shea, Transworld Business Advisors. I'm here with Mike Hershaft at Celtic Bank. Good afternoon, Mike.
Hey, Mike, how are you?
I am rolling.
Awesome.
So I've got cool real stuff. Mike's got toy Star Wars stuff behind his desk, including a Death Star lamp, it appears. Is that what that is?
Death Star Lego set.
Death Star Lego set. My son would think that he's out there putting some together. So we're not going to talk about Star Wars. We're going to talk about the new world, SBA interest rates, and how inflation pressures affect deals. So I guess last time we talked, reference SBA was during COVID,
right?
And money was free, and we had a different president, and we were doing deals left and right. So let's kind of fast forward to probably first quarter of this year, and the new regime, a new president, and what's happened on the lending environment. So let's go there.
So lending, and I can only speak generally because every lender looks at things differently, obviously. But I've been doing this for 18 years, and lenders are typically going to look at each deal individually based on their own merits. I would say the one thing that lenders are probably doing, if they haven't already started doing, is doing a rate sensitivity test, meaning that the current rate of prime plus 2.75 is 8.25%. But what happens if that rate goes up a point? What if that rate goes up 2 points? I remember back in the day, back in 2004 to 2008, the lender I was with at that time, they did a 2-point rate sensitivity test. They call it a stress test, to see what happens if interest rates moved up 2 points. What would that cash flow look like? Mm-hmm. So I could tell you where I'm at now. As they're looking at deals, they're saying, well, what happens if rate moves a point? What does it look like? So I would say a rate sensitivity test or a rate stress test. I would imagine a lot of lenders are using that right now to test the cash flow of the subject business that someone would purchase.
So let's real world talk through that. So for through COVID, what was prime? So because I want to
3.25%.
Right. So 3.25%. So banks were basically lending at 5.5 to 6.
Correct.
So whenever I have to explain this to a seller and a buyer, they're like, they don't really understand how the lending environment works. Like, you guys borrow money from the Fed. So when they don't pay attention to CNBC and go, what's the prime interest rate? How does that affect the market? Well,
right
here, this is how it affects it. The banks borrow money from the Fed, right? At 2 years ago, it was what, 2%?
Probably even lower than that, but yeah, really low.
Right. So then they make money by lending on points on top of that, right?
Correct.
In various different vehicles. And the SBA note is a 10-year note, so it's amortized. So what you're saying is, and we've done in the last 6 months, how many interest rate hikes?
I would say
2.
There was definitely 2 3/4% ones, but there may have been another one, but definitely 2.
Right.
2 I know for a fact.
Possibly 3.
Possibly 3, but there's going to be one this month too.
Right. So, and we think it's probably going to be 1/4 point, right? So now it's
actually the speculation that it's going to be 3/4 point.
Oh boy. So then the lending rate to the borrower is going to be what? Probably
the lending rate to the borrower, if a deal's prime plus 2.75, is going to be 9%.
9%. Now, the optimists in the room, of which some of my partners are, will go, well, historically, that's cheap. Yes, historically, that is cheap.
Correct.
Not in my lifetime. So not in the 17 years I've been doing business deals have I seen 9%.
Well, so actually, I took a look back, and believe it or not, from 2006 to 2008, there was a time where the prime hit 8% for a hot minute. But it was hovering, prime was hovering in the 7s, high 6s and 7s.
So, but 2006, 2007, we were on a freaking rocket launch, and Fed was trying to cool down.
Correct. correct. And then we know what happened in 2008 and 9.
Right, because I had just gotten into business in 5.
Okay.
I do a lot of banking deals, but I do remember it was crazy. People were doing deals all over the place.
Yep.
And, you know, it was just free money. And this was the housing crash, right? So
Right.
in an effort to cool down the economy, the Fed raises interest rates, that cuts back on borrowing. And then it's supposed to cool things off in like a, you know, a managed way, but it never really works that way. It's always a, oh shit, and then everybody pulls back.
And that's the interesting thing, because back then in 06, 07, the prime rate was in the mid 7s, but it, like to your point, the economy was just blowing and going. It was crazy. Obviously the economy is doing okay now, but is it to that level where they're going to keep it, you know, raising rates? Now they're doing it just to tame inflation. So it's definitely interesting.
So in our world, relative to business deals, and let's use the deal I put at you the other day. So large pool company, good books, and I go to meet the seller. And the tragic situation was the seller's husband died.
Okay.
And she says, well, I need to sell it. And my friends and my father and my cousins are all telling me I should get $1.5 million. And I go, that ain't ever going to freaking happen, ever. Right? Because no one has $1.5 million in cash to pay for goodwill. So the only way that gets done is an SBA deal. And I probably spent an hour explaining, and this was about a month ago, that there's not enough meat on the bone. And my layman's explanation of how this works is that the banks have to have a certain ratio of free cash flow above the monthly debt service. So, you know, hopefully I get sellers to understand that, hey, if there's $100,000 in debt service, there needs to be $150,000 in free cash flow to service the debt above a salary to an owner, right?
Correct.
Because the banks are going, how are you going to eat? And there has to be enough money to service the debt plus a buffer.
Yep.
So, you know, that's always a smack in the face to people, because when they do valuation in their minds or they're talking to their friends, they think that multiples are static and that no matter what goes on in the outside world, that their business just increases in values and then they can just go out and get a buyer. And I'm like, no, the limiting factor is the ability of the borrower to get money once the deal gets above $300,000. Historically in Main Street business brokerage. And, you know, so I threw that deal at you. And I think the cash flow was like $300,000 consistency for the last 3 years. And you're like, yeah, we can do it today.
Yeah, it was
At one point
like that. It was as of today, the cash flow is tight, but it works.
Right, it works. So when I send deals to Mike punches it literally into a spreadsheet, looks at the records to see if they stand up to scrutiny, and goes, okay, based upon the seller's books look like X, and assuming we have perfect buyer, I'm giving you the blessing, we're good to go, right?
Yep.
You caveated with, oh, by the way, in about a month, there's going to be probably a 3/4 place interest rate hike. This probably ain't going to work.
And this is where I think it may get tricky for you guys on the brokerage side and sometimes on the lending side. So the way the SBA models their valuations, it's based off of 3 years of historical cash flow. Now, but we need to debt service coverage a deal, you know, at 1.25 or 1.15 or whatever the number is. So there may be a situation where a business is actually worth what you're selling it for, what someone's buying it for, but it may not cash flow the debt. And that's where it gets tricky, because, you know, that's where either a buyer has to come up with more equity, because I think the valuation will still probably come in, or unfortunately, the purchase price would have to come down because it's got to meet the debt service requirements. So from the financing side, it not only has to meet the debt service side, but it also has to meet the business valuation requirement as well.
Right. And I think that's something that people get lost on, is that it's not tricky. It's valuation is separate from how do I get a deal done. They're totally different deals.
Right.
It's like, hey, if you tell me you want to value a business, I can go out and do a value. It's whether or not I can get it financed, and, you know, will it work? Right.
Yep.
Given the outside forces that's going on in the economy at 9%, it ain't going to work, because what happens when money is lent that way and there's inflationary pressures, buyers get more conservative. So buyers aren't in a vacuum, right? If everything they do is costing them more money. Oh, by the way, let's take that business, for example. That's a route-based business, a pool company. Gas prices have gone up from where they were a year ago, right?
Yep.
And the supply chain, I mean, I'm seeing some stuff like there's some threats of strikes and the rail system. And holy shit, if the rail system goes down, it's a massive crippling effect to every manufacturer and every retailer out there, because you literally won't have stuff on the shelf.
Right.
So what happens? Supplies drop, prices go up. You either pass that on to the consumer, but literally if you're a buyer and everything else is going up in your life, your ability to just put more money down goes away. So it has to, what 9 times out of 10 happens is the seller, and hold on to your pants, sellers, you need to come up with seller financing to bridge that gap, because the bank is the bank, right? They've got $1 million, they're going to lend on it. The ratio is set in stone. It's not going to give. So the seller, if they want to sell, need to help bridge that gap, right? There's
Yep.
the seller, there's the buyer, there's the broker, there's the bank, there's these, it's a foursome here, and they're all trying to figure out how to get this deal done. Certain people are going to give and certain people aren't going to give. Don't look at me, I ain't giving. It ain't coming from my end. That's between
Right.
the buyer and the seller, but the seller is probably going to have to come up with seller financing to bridge the gap, to get the bank comfortable so they'll lend on the deal. Or you're going to wait to an unknown period until the rates come down, which is probably another fiscal year at least.
Yeah, correct.
At least, right. So, and the reason I wanted Mike to talk about this inflationary pressures is that, there's a tendency in my world for buyers, sellers, and brokers, frankly, to look at things in a static way. And I think that's human nature. It's like A plus B equals C, right? And they don't understand, my wife doesn't understand why I have CNBC on the TV screen next to me, because we don't sit in a vacuum. You talk a little bit about that, how small business financing is a function of a larger entity, and how banks, I always tell people, banks have their own balance sheet. That's why certain banks will lend on certain things. Like you guys have a current, like you have a limit right now on how low you'll go, right?
Yeah, on a loan.
Yeah.
Yeah, like we don't really want to look at loans under 350,000.
Yeah. And you won't look at certain sectors.
As long as it's eligible, we'll actually look at anything.
Okay. There are, but you have been at banks that wouldn't.
Oh,
right?
yeah, absolutely. There are banks that they don't like trampoline parks, or they don't like hotels, or they don't like gas, whatever. Every bank is different with what they're okay with or not okay with.
And what's that based on? So the buyers can understand.
I would say it's based on performance of their portfolio, and every senior credit officer may handle that differently. You may have one credit officer who has a trampoline park go bad and they've done 20, but they may say, I'm not doing it anymore, or so it just really depends, but it depends what's in liquidation, what they're taking a beating on, and how many they have, and just their overall risk tolerance.
It also has to do with their entire balance sheet, right? So if you're
correct, because once you have a loan that goes bad, now you're eating up some of your capital reserves. And then once you're eating up your capital reserves, that makes it harder for you to lend. So, correct.
So say you're a bank, right? Like I was watching when COVID happened, and everybody, the restaurants were calling because they literally were shut down. And I was picking phone calls to landlords going, don't kick these people out. They're the only tenant you're going to get, right? You need to keep them in place. And I was sitting there waiting for the plazas that had like 2 or 3 restaurants in position. And remember, most people, when a tenant or a buyer comes to me, they look at a plaza, I'll give you that. Let me just digress here for a minute. So today I went to a restaurant, licensed for 12 seats, strike one. It was $3,000 a month in rent because they financed the hood system with the landlord. 6 months ago, the building sold to another landlord. So I was like, well, the landlord just took the tenant because you were basically paying for the financing on the hood system, and the guy in the unit next to him was on a month to month. So you basically put in infrastructure for that landlord to improve a facility for them to sell the building, so they had occupancy in there when they sold it.
Right.
You finance their ability to get out of this property. That's out in Lakeland, right? So what buyers and sellers need to understand is that landlord, their vacancy rate dictates their ability to borrow and lend, right? It's how they make their money and how their value is predicated, right? And the willingness of refinancing comes from their occupancy. So when COVID hit, I was begging the landlords, please be smart enough not to kick out your tenants. Because if you kick out your tenants, there's not going to be anybody to replace you, because I don't know when COVID's going to end, right?
Right.
My real worry wasn't that, because I don't sell a lot of restaurants anyway. My real worry was what was going to happen to the banks that held that note, right? Who are heavily lending on commercial real estate.
Right.
They were going to pull back because they were going to eat that loss, and then their ability to lend into the SBA would be, which is what happened in 7 and 8. Remember?
Yeah.
Right?
Yeah. Mm-hmm.
Yeah. So in 7 and 8, I mean, I think 2008, 2009, the amount of SBA deals in Central Florida dropped through the floor.
Oh yeah, absolutely.
So like Mike's like, I don't have a job, right? That's going on. And it was because their balance sheets were so heavily skewed to bad loans on defaults.
I'll put it to you this way. When I left one bank to go to another bank, I was there for 6 months. And 6 months to the day, they did a 180 on their credit philosophy.
Mm-hmm.
I left that bank. I was in and out of that bank within 11 months. I don't even think I was there a year.
Yeah.
Because that's how quickly they changed because of what was going on with the recession. Because I knew I would never get another deal done again.
Yeah.
But it was like literally 6 months, like they dropped, like just closing a door. It was, so you're right. Banks,
yeah. So
banks make changes like that.
What's super important for buyers and sellers to understand is you have to look at your banks and your lenders and understand who does this stuff. Like routinely people come to me and go, I'm going to go to one of the big ones, right? And I'm like, please don't. They're mortgage lenders, or they lend on cars, and if you look at like defaults on car loans right now, pretty high, right? Yeah. Or they're lending on trailer parks, or just, you always want to look at their balance sheet as an indicator of their ability to get a loan done. Now, the average buyer and seller is not going to know how to do that or which ones to not look at, but people like us do. Like, we know who's going to do something and who's not going to do something based upon they're part of it. They're this third leg of the stool, and their balance sheet dictates what goes on. But what do you see happening with these interest rates? What's going to happen in the SBA world?
I mean, as long as the rates keep going up, that, obviously the prime keeps going up, our rates are going to keep going up. And when our rates keep going up and lenders' rates keep going up, it just puts pressure on the cash flow from a debt service coverage standpoint, which sometimes makes it a little more difficult to get deals done. Just because if a deal, like we talked about before, a business could be worth it, but if it doesn't cash flow, I still can't finance it, right? I would be surprised if lenders are not stress testing their deals right now. Just saying, what happens if interest rates move up 1 point to 2? What is?
So they are. So pre this call, I went out and called 4 other lenders and said, given your comment, when you sent me that comment last week about, hey, this next quarter or this next interest rate hike, this is going to get dicey. I called 4 others and said, do you see the same horizon issue coming? And they're all going, yeah, we're going to have an issue. So to the buyer, right, it's like you actually have to buy something bigger and accept that you're going to have less of a return.
Right. Yeah. You have to have, well, first you have to buy a business that you're not scared if interest rates go up, because the cash flow is super strong. And typically, if you're buying a company with super strong, high multiple cash flows, you're going to pay more for it. I mean, that's typically what I've seen.
Yeah. Well, but to the seller damn well better not overprice it.
Correct. Right. And that's the thing. I'm always more than willing to get on a phone with a broker and their seller if they need to. Or what I do a lot, because with other brokers I work with, and we've had this conversation before, you're like, when I say, listen, I like the business, but I think it's priced a little high. I think it's more like this range. And then usually the comment I get back is, do me a favor, send me an email with exactly what you just said, because I want to prove to my seller what I already told him.
Yeah.
And then I just, say, hey, listen, it looks like a nice business just based on the cash flow. I can't get it done. If it was priced at this, it works, and a lot of time it's in agreement with the brokers, because a lot of times you guys know when it's priced just too high.
Well, we do. I mean, Andy just put out we went back. So now that we've got the national footprint, we went back and went through all of our sold statistics since we've had the franchise system. And he sent us these PowerPoint presentations about how long they sit on the market, what happens if you there was one that was, if you overprice your business, you have an 80% chance of not closing.
Wow.
It was mind numbing. And it said, if you were 15% higher than what, because when inside our internal system, we have, here's what we think the valuation is. Here's what we listed at, because we wanted to track what happened when you didn't listen to us. So when we go on a listing appointment, we present the comps, we do the valuation according to GAAP. When I get your deal, I had to argue with the seller and their CPA as to why my valuation was not 1.5, it was closer to 1.3. And oh, by the way, you're holding paper, right? Why I had to have that conversation. And the sellers, no matter how long you have relationships with them, look at us like we're just salesmen and we don't care. And I'm like, no, I want to sell this.
Right.
Or you want to sit on the market until I sweat you into the box to get you where you need to be. But the data was, if you don't price it right, you're not going to sell. And if you overprice it by more than 15%, you're not going to sell.
So I have a question for you, because I don't know this, and I don't know if you know this, but I'm assuming you probably will. Out of all the listings that are on the BBF, on a percentage wise, how many don't sell? So if there's 100 listings, how many won't sell?
60%.
How much?
60%.
60% will not sell?
Yeah.
Wow.
And that's for bad books and records, overpriced.
Right.
They have bad balance sheet. Like you made a reference as to, you have to overpay in order to have sufficient cash flow, or they're just bad business owners. Like to me, I walked into that restaurant today and the woman had built this restaurant from scratch. And I went, the first thing I did, licensed it. How many feet? How many seats? There's 24 and they're in 12. I said, what's your average price per plate? They knew the average price per plate. I said, okay, you're at 100% occupancy. You're only open 5 days a week. You need to be open 7 days a week. And you're still $1,000 short of paying your rent. That's before labor, cost of goods, equipment, electric. It was a loser.
Wow.
So that's a bad owner situation. I didn't do my backward math. I just thought I'd do something. And there's other reasons why, but the primary reason people don't sell is they overprice. And the reason they don't overprice is their experience with negotiation is like, they don't want to leave money on the table. And here was the other one. When we did the statistics, when you price it at the right multiple, you actually sell 50% of the time. We'll sell for more. Really? You get a bidding war.
Oh, no kidding.
What happens is they list and then they lose their leverage because they start to sweat down. They get, they start to pivot, and it's like blood in the water. If you list at the right price, you get multiple bids, you hold the high ground, you're able to leverage people up.
That's interesting.
But no one ever did the data. Now we have the data. So now I can sit there and go, look, this is a statistical fact. If you don't listen to me, don't blame me.
Right.
That's
really interesting.
I get a call from the accountant on that business you pre-qualified, and I'm like, you're a CPA, for the love of Mary. You understand debt service. It's about to go up.
Right.
How much meat's on the bone? Well, you got all the add backs? Yeah, I got all the add backs, but banks only accept certain add backs.
Right. I was going to say, from their standpoint, there's a lot more free cash flow than what I'm accepting or we're going to accept.
And I'm like, and in this case, you did accept them. They were all good ones. I'm like, it doesn't matter because the interest is going to low, and the bank's got a 10-year note on the back end. They're going to lend for 10 years. They're trying to go, how's this going to look in a year? How's it going to look in 2 years?
Right. That's right. Yeah.
And if it doesn't look good in 2, 3, 5 years, they're probably not going to lend on it, given what they forecast the future to be. Cost of fuel, wars, COVID. They all think like it's just, hey, does it work? I'm like, no. There's actually people sitting there in the risk department forecasting the next 10 years. That's literally how it works, is they try and predict what's about to happen and they lend based upon that information.
Like It's funny you say that. So on the SBA side, I can tell you, there's times we like the recession word. And the only reason why I say that is because once they come out and say we're in a recession, all the big banks that you talked about, they stop lending.
Right.
They're done.
No.
So now you have the non-bank lenders like the one I'm at, who were like, that's fine, we'll take your declines because, or you're not doing it, so we'll finance them. And actually when COVID was, when it just started, all banks just stopped. They're like, we're done. We kept lending. So you're right. Banks all have a back office that's looking at future things and what they predict or not going to predict. And definitely the bigger banks are going to be a lot more conservative than the non-bank lenders, or even like we don't balance sheet our loans. We're going to sell them and we only hold the guaranteed piece. So our balance sheet is.
Stop there. They got to sellers and buyers of small businesses need to understand that the banks do something with this vehicle.
Yes.
They're going to sell it, right? So they're going to they're going to create the asset, and then they're going to sell it to someone else who's probably going to sell it to someone else. And in your case, your bank is not a bank. It's a non-bank. It's not
correct
mortgages and
Yep.
freaking retail banking, and it's none of that garbage. While a Bank of America has got credit cards,
right?
And the $30,000 guy who's $60,000 in debt on credit card, that's going to default. And by the way, they're looking at that as risk, right? And if you've never seen The Big Short, go watch The Big Short.
I love that. I love that movie.
Right, but that's literally how banking works. And then someone finally goes, "Oh, wait a second, we got a problem," and then they adjust. Now it's far better than we're far better when we were 10 years ago when the nonsense happened the first time. But the bank has to make ton of money too. They're not lending for Jesus. They're lending to make a profit, and they're not going to write bad loans. And if they do write bad loans, they pay for it very quickly, and then it causes the pullback. So what's the horizon for the next 2 years, inflation wise?
I mean, I think they're going to, well, obviously they're definitely going to raise it in September. I'm even guessing they may raise it again in December, but I'm thinking and hoping that they curtail it in 23 and let this digest with everyone. Let's see what happens. Because the prime's at 5.5 now. If they raise it another 3/4, that's going to get it to 6.25%. You're at a 9% interest rate on a deal. And let's say they even raise it another 0.5 point at the end of this year. So then you'd be at, 6.75% on the prime rate. Not as high as 2006 and 7, but a lot higher than where we were, and probably a more realistic rate where we probably should be. We were probably, I hate to say this, but we were probably too low for too long.
No. We were free money artificially stimulating, and the chicken's coming home to roost.
Yeah, I mean, so
those of us who are old, like I'm old enough to remember Jimmy Carter, right? And I'm old enough to remember 91, 92. And so I've seen this like every 10 years stuff.
Right.
But I've got some clients who are like still in their 30s. This is like they're not really with the program on they're beyond. They've never seen this before.
Right. Correct.
That goes to my comment of you got to be a good business person and think past, like, don't drive the nice car, don't have debt on your vehicles, have cash reserves, think at least 3 to 6 months out. You got to have the old Dave Ramsey, have 3 months worth of working capital on your balance sheet instead of all the stuff I don't normally see. You got to start acting that way because this is starting to reel back, and you got to be able to read the tea leaves. When the waves start rising, you got to see what's about to happen.
And that's one thing. I know this is slightly off topic, but when we're looking at financing the buyer, we want to make sure after their down payment that they have a reserve. Like that's one thing we look at. We call it post-close liquidity. Like, what do they look like after they make their down payment? Because, well, as well as anyone, they're going to meet some ebbs and flows in that business that, they got to cycle through it to see what's going to happen.
Yeah.
And what we as a bank, we don't want them to call us up in 3 months saying, "Oh, I need to borrow 100,000 for this, or I need to borrow for that. I was like, that's why we don't want you
Well,
to.
I mean, yeah, we did, Muhammad, right? Remember
Right.
Muhammad? We did that deal and he got that land and his land value's gone through the freaking roof.
Oh yeah, he's killing it. He's
He's
doing a
killing
good
it.
job.
And he's got tons of equity because he bought the land at cheap money on the bottom of the market.
Yeah.
And because of COVID, now everyone's moved here and his value, he's got all this extra liquidity because he did a good deal. He
did.
leveraged properly and did a really good deal.
Yep.
But he had hiccups.
Oh
He had
yeah.
hiccups in the first 60, 90 days. But
Oh yeah. Yep. Him and I spoke a few times, but he's smart. He was smart enough to figure out what to do.
Yeah.
But also we didn't over leverage him. We left him with a cushion so he can absorb some of the unexpected, you
Right.
know. And every business unexpected is going to be different, right? I mean, you can have a little blip as an unexpected, or you can have something catastrophic as an unexpected, you know.
Right.
But
Right.
but yeah, he was a good case example of that.
Yeah, so we've done some good ones. We've seen other people go that just look, the reason we have the rules and the ratios and the benchmarks in place is because 9 times out of 10, they're correct. And if the deal doesn't work, you can't shove a round peg into a square hole. It's not going to work and it's not safe. And the banks aren't going to participate at 9 times out of 10 unless something crazy is going on.
Right.
All right, we're running short on this one. So why don't you give some information about the bank and you and how people can get a hold of you?
So as you know, I've been an SBA lender for 18 years. This is all I know. I hope Mike would agree with me that I'm a pretty straight shooter. You know, if I can't do a deal, I won't pre-qualify it for a broker. I know some of my competition will. They just like to put their name on paper. I don't do that. I was formerly trained in credit. So if I look at a deal, I pretty much know if there's a deal or not, you know, relatively quickly. And then the bank, Celtic Bank, you know, we're national. We can lend anywhere. We're a preferred lender. There's no industry we can't look at. I could do an interior and exterior hotel or motel, makes no difference. Car washes, any special use property, again, as long as it's eligible, and as long as it's not contaminated, you know, or no, you know, issue,
Yeah.
we could definitely look at it, you know. And our turnaround time is, you know, we could get a loan approval with a complete package in about 2 weeks. So we're not the fastest, but we're certainly not the slowest.
Mhm.
But we're a very good generalist lender. So like I said, we can look at anything.
Okay. Phone number, email?
Sure. Phone number is 407-615-0329. And email is mhershaft@celticbank.com.
All right. Thanks, Mike. This is good stuff.
You got it, Mike. Thanks for this.
All right. Bye-bye.
Bye.